Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only. It doesn't take your personal situation into account. With all of that said, let's get into our first chart. So we'll start off here with the SP 500. And it's been a fairly lackluster week, at least at the time of filming on Friday afternoon in Sydney, and really haven't seen a great deal of movement in either direction. I think that the concern for many investors is whether a larger pullback is getting underway from the high in late March, and that does remain a possibility. But I think it's too early to be calling an end to this large bullish phase that has been in place for coming up to 6 months now. And let's not forget that on average, the market has around 7 3% pullbacks each year, and it has around 3 5% pullbacks each year. So what we've been seeing so far, what we've been seeing with this pullback towards the moving averages so far, it really isn't out of the ordinary. And in fact, the S&P 500 hasn't had a single 3% pullback this year. Like all these pullbacks we've seen along the way, they've all been between 2 and 3%. Nothing's actually got the 3%. And to get the last 3% pullback, with of course the exception of this 11% correction we had towards the middle of last year, to get to a 3% pullback, you've got to come all the way back here to May 2023. So it's really the strength we've had in the market over the last 6 months. It's really has been standout strength. We don't see it that often. Looking at that, looking how it's currently structured, we probably shouldn't be surprised if we do see more consolidation of these gains over the coming weeks, given that we haven't had those many of those pullbacks. We can actually work out what a 5% pullback would look like. So measuring from the high, coming back 5%. This is the sort of range a 5% pullback would operate in. And so look, this isn't a prediction of what I think is going to happen by any means, but it's just to put some perspective around the current price action, what we generally see in these markets, that we do see these pullbacks of 3 to 5% periodically each year. This is what a 5% pullback would look like. It doesn't even come back to the 100-day moving average. I was asked a really interesting question in the media this week. I was asked what sort of signs I look for. What do I look for in terms of trying to identify the top? And my answer was that we really can only identify a top of a market in hindsight, wherever that top may be. It's only in hindsight that we can really put it together and pinpoint it. And my base position at any high is that the trend is still up. And I'll view the initial 3 to 5% decline from a high point, wherever the high point may be. I'll view that decline as a routine pullback within an ongoing advance. That's going to be my default position. And I think if you don't take that view, I think it's going to be really hard to stay on these big multi-month or multi-year advances when they happen, because each time the market comes back 3 to 5%, you get scared and you jump out, so you can't stay on those trends. So I think that's why the default position should be that the trend is up until you really get those signs that it's no longer up. And sure, there could be warning signs and cause for concern. I'll actually show you a warning sign in the current setup in a moment. But at this point in time, I think the trend is very much up until it breaks down. At this point, it has not broken down. It's interesting to look at the rally from 2021. So if we just come back over to the 21 period, and there were several pullbacks of the 3 to 5% variety. You just look through this period, and you got several of those pullbacks between 3 to 5%, and it was a big, long-lasting trend. But to capture a big portion of that trend, you had to sit through many 3 to 5% pullbacks, and generally the pullbacks, they came back towards the 50 and the 100-day moving averages, and generally held above the 100-day moving averages. So there weren't a cause for great concern. And we actually had a warning. One of the warnings we got was towards the high, well, we're actually at the high, where the market broke out of this trading range it had been in for a couple of months, broke to the top side, and then quickly U-turned and came back down, came back to the 100-day moving average, rebounded, couldn't sustain that rebound, then fell below the 100-day moving average. So this is where the potential for a top really does start to come into play. And so once that rebound failed, back below the 100-day moving averages, the odds of the notable top was very much increasing. And we also saw the structure of the market change, with the consolidations now being below the moving averages. And once a market's consolidating below moving averages, that's when it's vulnerable. And that's when you really start looking to protect risk and be concerned that a top is in place, not when you're getting pullbacks towards the moving averages and the trend is up. So there's a distinct change in the structure when the chances of the top start to become higher. But it's not until after the high is in place you can actually start putting those pieces together. And that's why I say my default position at high points is going to be that the trend is still up. So sure, you can get those clues that a top's forming. Maybe you reduce risk, but outright predictions of a high often prove to be wrong. So I think the best way to maximize your profits is to stay with trends until you have clear evidence of a top, which of course will be after a top is in place. Now, I'm going to talk about the current setup in the SP 500 in a moment, but if you're getting some value from this, please hit that like button. Please leave a short comment. Just tells YouTube the right messages that people are watching and engaging and getting something from this. It shows other people. Now, coming back to current times in the S&P 500, from an overall trend perspective, as I've been saying, I think the bull market remains intact. We still have a market that's trading above the rising 50 and 100-day moving averages. So, as I've been saying, I think the underlying tone of the market does remain bullish until the price action tells us otherwise. One point of concern, though, one point I think we should be aware of is that there is some diverging strength of the indices. So, got the S&P 500 here, so we can see the high point. We can see we had a shallow pullback so far. Go to the NASDAQ, and it's very much a similar situation. Only a shallow pullback towards the 50-day moving average, and looks very much like a consolidation. It looks like it wants to break to a new high. Come over to the Dow Jones Industrials. Different situation, where the market has been pulling back for several weeks and is actually down near a 2-month low. So this is quite different to what we're seeing in the S&P and the NASDAQ. We've got the Dow Jones losing some ground, and the same can be said if we look at the S&P 500 equal weight. It's not looking as sturdy as the S&P 500. So there's more stocks which are pulling back. And also, if we look at the Russell 2000, the small caps, it's given back most of the gains that were made over the last month. So the gains that were in place from the March low had a rally to a new high point for recent times, and most of those gains have been given back. So there is, I think, this divergence in the price action. I don't think it signals a high, but I think it is a reason for some near-term caution. Maybe that larger pullback of 3 to 5% isn't that far away. I think the most appropriate strategy is still to let profits run. So if I'm in a profitable position, which has been making money, I want to stay in it. I want to keep letting it run until the price action tells me otherwise. And as always, I'm using those wide trailing stops to manage risk. And the reason they're wide is I want to be able to see off these 2 to 5% pullbacks we have along the way. Try and stay on a larger trend for as long as possible. But if a pullback turns into something even bigger, well, I want to have a way out. But I'm not enthusiastic about buying the index at this current level, just given that risk factor I'm seeing with that divergence in the strength of the indices. Also not too keen to be buying stocks that have been running hard. Happy to hold some stocks which have run hard. I don't want to be buying stocks for the first time that have run hard. Doesn't seem to be an asymmetric entry point right here and now. I think we can take our time with buying and just see how this price action plays out over the next few weeks. So look, hopefully that's been interesting. Hopefully it gives you a few things to think about. Thank you for joining me. Look forward to coming back, talking to you next week. Till then, bye for now.